All right. Hey, Simple Passive Cash Flow listeners. Today we're going to talk about life insurance, but not that normal kind of life insurance that you hear about, term life and all this other, I think a lot of them are kind of scams in my opinion. I'm going to talk about this form of life insurance where it's called many things. We're going to be kind of calling it wealth formula banking, but it's also known as infinite banking or banking from yourself, or whole life overfunded is another kind of form of it. But basically, what it is something that I do to help me smooth out my liquidity streams, and it allows me to stuff money into my life insurance, and I can take a loan out from it from time to time when I need it, and then I recontribute the money back when I have a little bit more cash. So we'll kind of go over it today. I've got the experts on the line, Rod and Christian. You guys there?
Yeah, we're here. Thanks for having us, Lane. We're excited to be here. This is kind of what we do full time, all day, every day. So we'll jump into a little bit more detail, and our hope is that by the time we're done, people feel like they've got a pretty good idea of where this banking concept might fit, and yeah, so that's great.
Yeah. So let's kind of I'll kind of kick you guys off here. I think the first thing that people always feel like are, guys are always trying to sell them stuff, and this is kind of no different in a
Sure.
way. I mean, it's life insurance. There's some fees associated, but
Yeah.
there's a big kind of a tool to this kind of a thing, and maybe tell us a little bit about the difference between the whole term life, whole life, and what this is, and how is it? There's all this talk about tax free and stuff like
Sure.
that.
Yeah, and we'll get into a little more detail on some more specifics on whole life, but the big difference between whole life and term insurance is that the term insurance is really it's pure insurance, right? So just like your auto insurance, you pay your bill. If you get in a wreck, they're going to cover you. If you on the life insurance side with term insurance, if you die, they're going to cover you. But that may be a 10-year term, maybe a 20-year term. When that time is up, then the insurance goes away. And chances are, right, if statistics play out, then hopefully you don't die, right? We're not planning or hoping that happens. On the whole life side, especially the way that we use it, is we're taking a totally different approach to it. We want to use the cash value. We want to make that cash grow just as much as possible. And again, we'll get into a lot of the details and the whys and the hows. But the idea is that we're using not as a pure insurance play, but as a tool that we can use to enhance the investing that we're doing.
So maybe another way to put it is we're going to be focusing in this situation, rather than focusing on the death benefit, we're actually going to be focusing on the living benefits that optimally overfunded life insurance can provide. So term insurance is great, right? I never want to suggest that there's no value in that. There certainly is. In this case, though, again, we're going to be focusing on how to use it as an investor, how to use it to create more cash flow. We're even going to get into an example where we show how utilizing this banking concept compares with just putting my liquid money in the bank and doing investing that way. So we have some numbers that we can even use to just kind of give a conservative, better understanding of what it does from a pure financial standpoint, right? Because here's my thought on this: is why would you do it unless it literally creates more money for you, right? And that's what we want to make sure that people understand, is that the value proposition is that we're going to literally create more money by doing this. So if I'm an investor and I'm going to be investing in the various things that I use, what we're suggesting is that it's not one of those things where we're going to say, hey, let's put some of that investment money in the life insurance policy. Rather, what we're going to do is we're going to use those two simultaneously. And the idea is that what we're talking about, will enhance the investing that we're doing by creating literally more dollars and cents over time. So that's kind of what we're going to get into. In fact, what I liked your kind of introduction on the way that you use it, Lane, because the purpose of wealth formula banking, it's really how cash flow investors enhance the investing that they're already doing, right? So I probably said that a couple of different times, but that's what we're going to be getting into we'll start with the vehicle itself and kind of dive in so that we have a little bit better understanding. Like you said, this isn't the life insurance that you get when you go down to the local Northwestern Mutual shop and you're looking for $250,000 of death benefit. Here we're gonna change that up completely. So we're gonna get into the vehicle, talk about how it grows, talk about the taxation. We're gonna talk about some of the other characteristics there. Then after we've gotten into the vehicle part of it, we're gonna turn and jump into the strategy, and that way we can kind of mesh those two, and we'll finish it off by having a conversation and talking through an actual example. So that's kind of what we have planned. Does that work for you, Lane?
Yeah, yeah, and I'll say, like, I'll emphasize it one more time. This thing is not for the life insurance payout, really. I mean,
That's
yeah,
it.
yeah, it's there, and
Right.
and then you guys, that's fine and dandy and all, but this is for liquidity and getting a little bit of return on your money while it's in there.
Yeah.
And it's kind of funny, some of my friends, they, when they heard that I was kind of doing this kind of stuff, they're like, "Oh, you should talk to my life insurance friend." Inevitably, everybody is like a life insurance broker out there. It seems like, just like how everybody's a lending broker. But so I talked to a couple guys that supposedly had, were quote unquote, "Oh, these are smart guys," but they didn't have a clue what this stuff was. They were just trying to stuff me in like index stuff, or they just didn't get it. They're like, "Well, why do you're only getting like 5% with this? You want higher?" I'm like, "No, you don't get it. We're doing this for the liquidity, for
Yeah.
the ability to take out that cash value and to go invest it." And they're like,
Well,
"No, you want to invest in this stuff." I'm like, "No, dude, you don't get it."
yeah, it's a great point. I think, yeah, it's not about the underlying investment return that's there, and we're going to talk about what you can expect to get in the policy. But like you said, this is where we're going to use this to replace the bank, right? So again, if I'm investing and I need to save up capital, well, where am I putting that capital? Hopefully, it's not in the bank. And then on the other hand, well, what if I put it into the market, like a brokerage account or something like that? Not necessarily a bad thing, but I don't know what's going to be there when I need to use it, right? So the value here is that it's really predictable. You know what you're going to get, and so yeah, we'll jump into some of those things. And one of the first questions that we get asked is, how does the underlying policy itself grow? So I'm going to talk about that first, and maybe I'll back up really quickly before I jump into that and just say this. Like you suggested, Lane, the whole concept here is that we've got to put way more money into the policy than what it would generally require. That's why we use this concept of overfunded. We want to essentially, and we do, absolutely keep the fees and cost as low as possible, and we put in the maximum amount that will go to cash. Again, we can get into this in some more detail, but it's really critical that the design is right in order to generate the return and in order to make sure you have cash value quickly that can be used right after you start the program, right as you start using the strategy. So, okay, with that said, how do we get the return? Whole life insurance generates a return in two places. First one is through a guaranteed interest rate. 4% is standard across the industry. We just know we're going to get 4% guaranteed contractual. The second part is
Maybe let's dig into that a little bit.
Yeah.
And I think one time you described it pretty well. Like, this thing has been around since like the Civil War or something. Like, you're talking like, and I guess, why is that? Like, who are these people? These like the insurance companies that are investing in
Yeah.
our state building, right? Like institutional kind of investments.
Yeah. So, especially with these whole life policies, essentially what we're doing is we're kind of riding the backs of the what the companies are investing in, which are a lot of bonds, right? There's a lot of fixed stuff, long-term stuff. So if you think about just the nature of a life insurance company, a 40-year-old gets a policy, it's a permanent policy. They're going to have that for 50 years, right, before it pays out. The insurance company's got to be really smart with the way that they manage their funds. So they're investing in fixed stuff, right, predictable stuff, and again, really long term. And so if you think about, between the guarantee plus the dividend, right now, 6.5%. Well, you can't go down and get that at the bank, right? It's been a long time since banks have been able to pay that kind of rate, but the insurance companies can because the stuff they're invested in it's really long
Well,
term.
and the dividend, it comes out in, I mean, there's three components to the dividend, right? So a lot of people think it's just about the return. First off, these are companies that have been around, like you said, for 150 plus years, right? One of our favorite companies started in 1847, has paid a dividend in every year of its history. So the reality is we're dealing with companies that have an incredibly long track record of being profitable. And again, it's super impressive when you consider that we're talking about going through the Great Depression, we're talking about world wars, obviously a variety of different economic situations. So from that standpoint, like we're dealing with companies that they just know how to do it. And so maybe the next thing to talk about is that dividend where, like Rod said, right now I can expect to get another maybe 2 to 2.5%. So when I look at the overall return inside the policy, we tell people it's reasonable and you should expect a 5 to 6% return based on the dividends today. Now, one of the nice things here is that dividends are kind of at a historical low. Now that may not be nice, but the powerful part is that as interest rates rise, dividend rates will rise with it. Let me just kind of finish off this, the three parts to what actually make the dividend go. So the first one is the way that the insurance company operates their business, right? So anybody that knows business or has a business realizes that you've got to generate a profit, right? So here, what they have is just their regular operations, running a business that's smart, well run, and generates profit. The second one is how they manage mortality expenses, right? So one of the big jobs of an insurance company is to price products so that it can be a win both for the insurance company and a win for the consumer. So what's happening here is they have to be smart in the way that they manage the mortality and those kind of things. Then finally, the third one is what Rod alluded to. That's the actual underlying investments. And those are generally going to be fixed investments that are long-term that they can use to generate at an institutional level. They can use to generate consistent, predictable returns ongoing. So anyway, that's kind of what makes up the return. And like I said, we've got an incredible track record of of dividends paying out and being strong and consistent. Okay, so hey Lane, is there any other questions from your side on maybe the interest and dividend before I move on to some of the tax components?
Yeah, I mean, I think it's just important to point out for the folks that, again, don't hold me to the fire if anything happens, but I'm pretty fairly confident that the stability of this contract, that you're going to get this return year after year after year, is pretty dang stable. Like, I mean, it's something that's new, but I would consider it as way stronger than any money market account out there, or even putting in the bank at their 0.01% or whatever they offer. Like,
Yeah,
it's solid stuff.
I think it's a great point. I mean, well, let's put it this way: we all know that the government they have never defaulted on anything like this, right, or anything from the bank. However, we also know that they're covering an enormous amount of debt, and so at some point, you have to just logically ask ourselves the question: would I rather have my money in a place that's backed by the government that's really, like I say, it's buried in debt, or I could work with an insurance company? In this example, we're talking about companies that have an incredible amount of capitalization. In fact, for every dollar that they owe out to a policyholder in the form of cash value or death benefit, they have to carry that same exact dollar in reserve. So what's happening here is you've got, again, if we're comparing to banks, you've got a really highly capitalized insurance company that has an incredible amount of cash on hand, whereas the bank is using leverage. Now, we love leverage, right? We want to use it ourselves as an investment tool, but I don't know if I want to be sticking my money in a place where they're dealing as much in that way. So again, we're not trying to replace the bank completely. What we're suggesting here is that the money that I would be using for investments, could be better utilized, particularly while it's outside of the investment, inside the policy. And then what we're going to do is we're going to get into some of the really cool concepts that can be used, and talk about how I can get the value in the policy and be getting simultaneous value outside of it from the actual investment. So that'll be kind of a fun overview that we'll hit into here pretty quick.
Right. So like it's the bank's gonna fail before your insurance policy stops paying this return out.
I believe that 100%. And I am biased because this is what I do, but the economics of it would suggest that that's absolutely true. Certainly an insurance company, especially these mutual companies that we use, which means it's owned by the policyholders, right? These, again, companies that have been around forever, extremely safe. So yeah, I wouldn't feel, there's no place that I'd feel more comfortable putting money than with one of these institutions. They tend to be the most solid financial institutions in the world. So yeah, that's kind of what we're using on that side.
So the next kind of feature here is this whole tax-free benefit. And I think this is kind of where, as the investor or the policyholder user, you kind of take advantage of the government in a little loophole in a way.
Yeah. No, there's no question. I mean, basically what we have here is an identical tax situation to what I get from a Roth IRA. Now, in a Roth, though, I have some limitations, right? I've got a limitation on how much I can put in it, and I have a limitation on if I make too much money, I just can't use it all of a sudden. Well, in the life insurance world, just like in a Roth IRA, we're going to put after-tax money in, it's going to grow, and it's going to be completely tax-free when we bring it back out. And we'll get into, again, we can get into more detail on that, but basically we're going to use a combination of bringing our actual cash back out in loans, and by doing that, we can keep that policy completely tax-free. And then what happens if I have a loan outstanding by the time I pass away, that death benefit will just come in and repay it. So really, any way we shake it, we're gonna make sure that the policy stays completely tax-free and will be identical to a Roth. But again, I don't have the limitations on my income or the amounts I can contribute. So I mean, we have clients who put hundreds of thousands of dollars a year into it, and then of course we have clients that put $5,000 a year into it. So it can really be fit to a variety of situations. The core thing to remember from a tax standpoint is that it's after-tax money going in, and it's going to grow, and I'm going to bring it back out tax-free. And so if you believe, like most people do, that taxes are more likely to go up than down, then that's obviously, it's kind of a no-brainer from that perspective. So yeah, it's really cool that way.
So this is the kind of stuff, like, this is like a prime example of like, hey, this is what the wealthy are doing, because this is just not what the regular people do. And what the wealthy have kind of found out, maybe talk to us a little bit about the changes in like how the tax codes are done, so that the people in politics were able to kind of stuff money in this thing tax-free.
Yeah, and from that standpoint, I mean, it's been around for a long time. So some of the tools, some of the ways we use it, like you said, are a little bit newer. But this concept of putting money into a cash value life insurance policy has been around for a long time, and the benefit, the kind of this tax favorability that it's attached to it, has been around for a long time. So cool. We're going to maximize that just as much as we can.
And like you said, it's a tool that the wealthy have been using for a long time, and because of that, there's a high likelihood that that's going to stay there and be effective, right? Because a lot of the people who are going to be voting on rules as it pertains to life insurance are people who actually use it in an effective way. And so, yeah, we always talk about, how some of these incredibly wealthy people, that their names that we know, Rothschilds and
Romneys.
Yeah,
Romney had like a super huge, like $1 million plus Roth IRA, and it's like, well, how the heck do you do that? You can only put $6,000 a year.
Yeah, there's ways to get around that too. So yeah, but really that's what they're doing, right? And so I have yet to meet with a client that has a $10 million net worth or beyond that's not very actively utilizing life insurance in some way. So it's kind of one of those things where it's kind of an under the radar thing, in the sense that there's still not a lot of people that know about it. And I think the reason is just because we get pumped so much with the Wall Street stuff from, you're not going to see very many commercials for most of the mutual companies that we use. That's just not the way that we work. It's a little different world that way. So yeah, anyway, it's been one of those tools. The wealthy have been using it for years and years, and our hope is that we can show people who are interested or intrigued how to use it in the exact same way to generate more wealth.
Yeah. So that 4, 5, 6% return, that's tax free because the loophole is that it's in a life insurance policy. Is that how it's kind of viewed as from the tax code standpoint?
Yeah. So life insurance, we often talk about how there's a couple of benefits that just exist from life insurance, and the biggest thing is that I can put money in there, and I can, as long as it stays in the policy, I don't have to worry about paying taxes on it. Now, when we get to a place where we might be taking money back out, this might be a little bit more detailed than a lot of people want to, but I'll just really describe it quickly. So we do it in two ways. The first way is that we can use our basis. So this is really actually unique to life insurance too. Most vehicles that have any tax benefits, when we put them in, we get that tax benefit, but when I take it out, I normally have to take out the first dollar has to be the growth, so I end up having to pay taxes on it. So in life insurance, it's actually flip-flopped. We call it first in, first out, which just means the money that I put into it, I can pull back out. So if I've contributed, let's say $200,000 over a 10-year period or whatever the number is, before I have to pay any taxes, even if I were to just withdraw the money, I can pull out that $200,000 that I took into it. Now, the next level for us is once we've done that, we're actually going to move to utilizing loans. And that goes back to that concept where I talked about using a loan. Well, let's put it this way. It sounds a little backward, maybe. It sounds a little obscure to hear the concept of loan and bringing income out. But in the reality, what normally happens is that during a person's working career, they're going to use this strategy and they're going to actively move money in and out of the policy. And then what we want to do is create a situation where it can basically be a Roth IRA bringing out cash flowing tax-free income in retirement for those people who want and need that extra cash flow. So it really has kind of a dual purpose from that standpoint. And I don't want to forget, I mean, we hit on this earlier, but there's also death benefit and long-term care benefit. So like I said, I won't get into that.
Let's stay on this whole like taking the money out, the liquidity portion, because that's really the whole point of doing it. So
yeah, that's great.
Recap. So what I'm doing today with my policy, like I stuffed like 60,000 in there because I feel like that's a good amount to kind of that's a substantial amount of cash that I can kind of use to smooth out my liquidity. So I put in 60, and we'll kind of get to this later. How you don't get that full amount up front, but I think I have my cash value at like 45, 50 now. So, like you said, I got two options. I can take a loan from it, number one, or number two, I can take out the basis, which that's a kind of new one to me. I'm more in what I'm doing is I'm taking a loan from it currently. So,
and for you that makes sense, right? I mean, you're using it as an investor tool. So there might come a time later in life where it makes sense to do the other way that I was talking about, but I absolutely think it makes sense from an investment perspective to use loans, and then we're just going to teach people how to cash flow and in and out of the policy to literally generate more money.
Right. And what you're talking about when you're doing the whole first in, first out, when you're getting the basis out, that's more for end game strategy, right?
Yeah. You nailed it. That's exactly right.
Right. Okay. Well, I haven't actually even thought about that, but yeah, that makes sense.
Yeah, it is. I mean, it's another feature that's cool because a lot of times, we end up working with a variety of different people, but one of the biggest segments of our market is we work with a lot of doctors, and they're kind of trying. A lot of them want to be investors, but maybe aren't necessarily investors, and so the value proposition there is that we can get into the investment game and you can use this cash, this liquid money to do that. But if you don't have to feel bad about the fact that it's sitting in the policy because it's still going to generate a 5 to 6% tax-free return. And so again, it's one of those things where if I can create the investment to go in tandem with it, then I'm going to create even more value. But again, 5 to 6% is a whole lot better than having money sit around in the bank and do nothing.
Right. So when I take a loan from my policy to get at that liquidity, I'm usually paying like about a 5% loan.
Right.
And I think what's important to point out, that 4, 5, 6% that I'm making in the policy, the dividend that's tax free, and the loan amount that I'm paying at 5%, say that's a, in a way, if you're smart, you can call it a business expense, which in my case I'm using it to acquire more assets and run a business. That's tax deductible. So in the original 4, 5, 6%, you take whatever your tax rate off of that, maybe a 20, 30% haircut after that. You're effectively making like a 5, 6, 7, 8% return, and your loan amount, instead of it being 5%, it's kind of like a 4%. So that's how we're getting this delta, and that's the magic that's happening there.
Yeah, and that really gets into the strategy side of things, where we're using it in conjunction with our investments, and we're really literally able to create value in more than one place at the same time. So, and part of it is what you're talking about, where I may be paying interest on that loan, but I'm also continuing to earn, because what happens is when I take a loan from my policy, that money that comes to me is not coming out of my cash value, it's coming to me from the general account of the insurance company. And so, quite literally, my cash value is all still there, continuing to grow and earn the interest and dividend. And then I'm using that loan out to create value somewhere else. And so, at the very least, inside the policy, we call it a wash loan, right? So I'm basically paying the same interest as what I'm earning. And yet, when you break down the numbers, we actually create a positive arbitrage there. And what I mean by that is that as I'm cash flowing money off of the investment and putting that back into the policy, essentially paying off the loan, then I'm paying simple interest against the loan. But the money in my cash value is going to continue to grow at a compounding rate. So just to kind of illustrate the power of how that works, let me just throw out some numbers. So let's just say that I've built up some cash value in my policy. I'm going to take a $100,000 loan and I'm going to pay that back over the course of 20 years, right? The payback is somewhat arbitrary, but when we do this, we're going to tie the payback to the cash flow coming off the investment, right? So as I pay that loan back, in the end, I would have paid a total of about $60,000 in interest over those 20 years. Okay, so then if we look at it on the other side, I have the cash value, that 100,000, still sitting in my cash value, continuing to grow and compound over those 20 years. So by the end of the 20 years, I would have earned $165,000 of interest in that compounding policy. So in other words, I earned $165,000 while I was paying $60,000, and so here's again one of the values. While that money is out, I'm using it in that investment inside the policy. I'm getting a lot more value by the cash value that's growing versus the interest that I'm paying on the loan.
And so this is all made possible through the loan provision, right? So we have this strategy of creating value in two places at once. We're going to use simple interest versus compound interest to our favor. So one of the things I always tell people is this isn't like rocket science, it's just math. And so if I understand the difference between compound interest and simple interest, I can use it in my favor because of the vehicle itself, right? And that's another thing that sometimes we neglect to do, but the actual banking concept can work by itself to some extent as a system. The life insurance piece of it comes in as a way to make it significantly more efficient because of the tax benefits, because of the predictable return and those types of things. But ultimately, it's really important to just understand that compound interest versus simple interest, even if we're talking about the exact same number, can work in our favor in a really, really significant way, especially as I look over time and as my numbers get bigger, as I'm investing more. Okay, so Lane, is there any thoughts or questions on that before we kind of move into the next piece?
No, I think that's that's really the reason why you're doing that.
Yeah.
It's a very small delta between the two, but this is just kind of augments it all, right?
Yeah, yeah, and I think what'll really drive this home is when here in just a few minutes we'll get into an example with numbers, and they're really conservative numbers, right? So we really tried to say, okay, let's assume everything conservative, and really we're not even bringing in all of the pieces, but nonetheless, what it'll do, I think it'll drive home just this idea that I can literally create more money just by doing the exact same thing I've been doing, but doing it in conjunction with the wealth formula banking system.
Yeah, yeah.
Okay,
And before we get to that strategy, let's just kind of finish up here with
sure.
all like the bullet points we've got. So you've got, all that stuff like we mentioned, the tax-free, the liquidity, the loan provision, but this is life insurance, so there's this death benefit that I'll let you guys kind of explain better than I.
Sure.
For some reason, like mine's had like an assisted living rider too. That was kind of
Yeah.
cool, I
Yeah,
thought.
that's I mean, again, we're focusing on living benefits primarily, right? And something like that could be tremendously valuable, especially down the road, right? So there's the two pieces here. We've got the life insurance death benefit. This can be valuable because life insurance is important, right? I mean, I look at my growing up, my dad passed away at 49, and luckily he was smart enough to not just save but own life insurance, and so my mom was able to continue to live the life that she was used to, right? So life insurance is a really powerful and good thing as a death benefit. So we don't want to completely skip over it. And really, inside of the system, you just know that you're going to have a death benefit. It's always going to be higher than what the cash value is, and so there's a value to that death benefit. But really, we're when we talk about that 5 to 6% return, that's the cost of any death benefit is included in that. So that's the net result of everything that's happening. The other thing that you mentioned, which is a really powerful thing, is just this long-term care component. So historically, and I'll do this really quick, but historically, well, first off, long-term care insurance in its pure form has only been around for maybe 15, 20 years. The challenge that it has is that they didn't realize how to or they didn't know how to price it. So a couple of challenges that go there. One, my premiums aren't locked, right? So it's just like health insurance in that way. I've met people who started out paying $300 a month, and then they're 10, 12 years later and suddenly they're paying double that, right? Well, they didn't go in planning to be able to have to go up that high. So that's one of the challenges. And then the other problem or challenge with pure long-term care insurance is that it doesn't always pay out. So there's a real possibility that I could put a lot of money into this and potentially never get anything back out of it. So here, the life insurance industry has been proactive enough to say, hey, there's room for us to do something in this space. What they have done is created for these policies a rider or an accelerated death benefit where you can literally use the death benefit while living to cover those types of expenses like assisted living, and really it's the same format from a qualification standpoint as what you get in regular long-term care insurance. So from my view, and from most of the people in the industry, the more efficient way to cover long-term care is just letting it, be just a extra benefit on the life insurance side because I know I'm going to get value out of it one way or another.
Right. And I think, you kind of mentioned it earlier, a lot of doctors, I guess they have a lot of liability. They always get sued all the time. And when the money's in these policies, it's sort of untouchable. I mean, it definitely makes things a lot harder for creditors to go in there and get
Yeah,
your.
that's a really good point. So the creditor protection, like you said, it's certainly not something we want to skip over because as an investor, my goal is to grow my net worth, to grow my assets. And so one of the other value propositions that exists with life insurance is that it is creditor protected. Now, the caveat there is that it differs from state to state. So now the cool thing is we have the ability to do, we can do planning to make it so that it's always completely creditor protected. But just understanding from on a state to state basis, there's going to be some level of creditor protection for those people that feel like that's an important thing, and that'll probably be a lot of people. We can do the things to make it completely creditor protected. So again, if you run into financial issues or legal issues, those types of things, we've got this money in the policy that will be away and not accessible to creditors. So that's a great point. I'm glad you brought that up, Lane.
I think we hit the hammer on all these bullet points here. Maybe let's make it come alive for the folks a little bit. And I'm gonna be a little bit selfish here, and let's say this guy, I have this friend that puts in $60,000 a year into this policy as kind of our basis for our numbers as we kind of walk through this. You guys can get your little Sharpie out and write on the
we can do a lot for sure. I think what we're going to focus on.
This guy, he told me he got like $60,000 he put in the day one, and then he got cash value of like 45,000 or something like that.
Yeah, yeah, and that's pretty typical. So maybe just to hit on that point, we expect to have at least 75% of our cash value available from right from the time I put the money in. Sometimes it leans a little bit higher than that, but generally speaking, we're going to be over that 75% ratio. And that's really the mark of a policy that's been designed well, right? As long as if I have that much cash available year one, then that's probably a pretty good policy.
The biggest factor is like how healthy you are, right? And I think a lot of guys, they call it like preferred plus or preferred. If you're, I don't know why preferred is kind of like unhealthy or something like that.
Well, yeah, no, you're right, and that can matter. What's actually really cool about these types of policies is that it makes a relatively small impact. So even if someone, we give them a standard rate or something like that, that policy is still going to grow really well. And the reason for that goes back to the idea that we are reducing the costs of the policy just as much as we can. So those kinds of health ratings make a big difference, a bigger difference in like the term world. But because of the way we're designing it, and we're reducing the cost as much as we can anyway, the relative difference on the health rating is going to be pretty small.
Yeah, and I'll second that. A few of us in the Mastermind club were kind of like got this thing about the same time, and different ages. One was like 50 years old. He wasn't a smoker, but I was like, well, I mean, so much for being, way younger and healthier. You pretty much got the same thing. So I think a lot of guys, like, they think, oh, I'm old, it's too late, I'm gonna get killed on like,
the pricing. Yeah,
that's a good. I think because this one's like it's not so much weighted on like the death benefit. Maybe is that why it doesn't matter or doesn't factor in.
That's exactly it.
We've reduced that just as much as we can anyway. We'll do that whether you're 20 or whether you're 60, and so that's why it really kind of normalizes, levels the playing field quite a bit.
Right.
Yeah, and I think it is important. We have people all the time who come and say, does it make sense? I'm 60 years old, and we'll run the numbers and show them, and we can even compare with someone's. So at the end of the day, for most people, I would say there is an age where it becomes less favorable, right? But really, if I'm below 60, then we can certainly put it together in a way that's going to look pretty similar regardless of what age you were. So yeah, that's a great point too. I'm glad you brought that up. Anything else you want to hit on from that standpoint, Lane?
No, I think just kind of do like a typical, so people can see how the numbers flow and how you actually use the thing.
Yeah, that's great. So why don't we do this? Why don't we just jump into a real life example of using wealth formula banking in comparison to the bank. I have in our notes to make sure we talk about how we use it, but I think we kind of covered it, right? So we talked about safety. We talked about the whole purpose of this is to create an opportunity fund. It's got to be liquid. We want to get a decent return while it's there. All of those things I think we already hit on pretty well. So my thought is let's jump into some numbers. I know a lot of your listeners are going to be pretty detail-oriented people, and so we'll jump into some numbers and give you a better idea of what the result of using the strategy ends up looking like.
Perfect. Okay, so for this example, we're using a cash flow investor, and we're saying, okay, here's somebody who is investing, is going to invest anyway, and so what's the relative difference between using their bank account as their opportunity fund versus using this kind of wealth formula banking policy? And so we're going to kind of spell out the numbers. So to begin with, what we're going to say is that the initial investment is going to be $500,000. In this example, we're using real estate, but it really could apply to just about anything. Again, money goes in, And then the idea is that it's going to begin to kick off some cash flow. And we're going to take that cash flow and we're going to put it back in the opportunity fund, let it grow, and then down the road we'll another opportunity comes along, we're going to go take advantage of that, invest, and continue that cycle. Cash flow coming off the properties, the investments, reinvest that later. And so on both sides, on wealth formula banking and on the bank side, we're using the kind of apples to apples. We're showing 15% cash flow coming off of the investment, and then as we rebuild the opportunity fund, going back out and reinvesting that.
Now, just before we go in there, I just want to put a little thought in there. So when it pertains to the numbers and kind of what return we're projecting out, like that's one of those things where some people will think that 15% cash flow is too high, and some people will think it's too low. But at the end of the day, it really is more about the overall context of what it's doing. So don't get caught up on whether you think we can generate that kind of return. We could easily put in 10% as that number, and the concept still works the same.
Yeah,
Yeah,
sure.
yeah, I think that's kind of fair. I mean, I think easily you should be able to stick it into something like AHP and get 10, 12% a year as your bronze level. And then I think 15% is a good silver level. And, the syndications are like around 20. So that's kind of the gold standard. But yeah, I think that's a fair statement.
Awesome.
Perfect. Good. Okay. So as we kind of play this out over time, we're going to show investing in a total of 4 different investments. And as you can see, when we fast forward to the 20 years out, we're creating an additional $800,000 worth of value by using the whole life policy, this wealth formula banking strategy versus the bank. And so it's all the different things we've talked about, right? It's the paying simple interest versus earning compound interest. It's having more money go into those later investments because it was growing along the way versus really not getting any growth inside of the bank. And so, and also, we wanted to keep this simple, right? We did not include the value of the insurance that we're getting, right? Either on the death benefit side or on the long-term care side or any of these other kind of peripheral, the tax-free component of it. This is just straight numbers run over this 20-year time frame. And so we end up with an $800,000 difference by using the whole life policy versus if we had just used the bank.
I think what is not shown there is I call this thing called liquidity anxiety.
Yeah.
A lot of folks like myself, they get really anxious when they got like more than 10, 20 grand in the bank doing nothing, making 0.5%. So maybe it takes a little bit of stress off, and at least you're making 4 or 5% or something like that.
Yeah, no, and like I say, with the dividend history being what it is, we expect it's pretty rare that we have a policy we're creating that's under 5%. So 5 to 6 is a good number. And like you said, if I compared that to a vehicle that didn't have any tax benefits, it might equate to 8 or 9%, just depending on what tax bracket you're in. But the value there, I think it's a really critical one because, like I say, you don't have to feel bad if you don't use it. And some people also, like you said, they get this anxiety and they feel like, hey, I've got some money building up, I've got to use it. Well, there's probably times where it makes sense to do exactly that and get that money out to an investment that's great. But sometimes, it might just make more sense to hold on to money, and we don't want it to be doing nothing for us. So here we have an alternative where we can grow that money, and then we can use it to, we don't have to feel bad if it's sitting there while we're waiting for a great deal instead of maybe taking one that we're not feeling so great about.
Right. Sometimes the best deal you do is the one you don't do. So if you're kind of stressed out about having like 100, 200 grand just sitting there not doing anything, you might be make a dumb decision and go into a deal that you haven't fully vetted or don't feel comfortable with, and you're going to stress about later. So you're trading one stress for another, and then it kind of goes to the point where like I'm always like, maybe keep your day job because that allows you to play from an abundant standpoint, and that way you're not making hasty decisions.
Yeah, and some people will start to feel the pressure of that. And they'll feel like, okay, instead of keeping that in the bank or in a safer place, let's invest it in the market or somewhere where I can get that growth. And the challenge there, if I'm using a market-based account as my opportunity fund, well, let's say a 2007 scenario comes around, I'm looking for the real estate opportunity out there, but there aren't many because the market is overinflated. Well, 2008 comes around, and good news is there are all kinds of opportunities around. The bad news is I lost a bunch of
Yeah,
money in the
most
market.
people don't have cash.
Right, so I don't have as much to go out and invest. And so, kind of like you're saying, you start to feel the pressure of that. You want to make your money work for you. And so, one way or another, you're probably moving into a poor decision. Whereas, in this case, at the very least, I know it's in a place where it's going to continue to grow and churn and do its thing, whether I take the loan or not, whether I'm using it for the investments or not.
Right. I mean, don't get me wrong. You don't want to keep it in this thing forever. You want to kind of fund it a little bit out
Sure.
and
Yeah,
get it
absolutely.
into a
And
more
that's
higher return investment.
yeah, no question. So it's nice to have the benefit of not having to feel bad, but and that again, it's just about being able to make good decisions. And I think you nailed it with the liquidity anxiety concept. I think that's right on track. So maybe what I'll do, Lane, is I'll just really quickly talk about what it looks like when we meet with people generally, right? So we have a couple. We have a couple other videos that we send to people for just individually. So once we meet with someone for the first time, we'll usually just get a basic idea of what their situation looks like. And I always tell people, like, we never want to try to fit a square peg into a round hole. This isn't right and perfect for everybody. For the right situations, it can work and be really great. So our job is to make sure that we're fitting the concepts and strategies that we use to the people. But what we'll generally do in that first meeting is fill it out, and then we'll send them what we call an illustration, which just basically shows the numbers, but it's more specific to their situation. And that way you have a chance to kind of digest, understand it. And then what we do at that point is we'll do another call and just kind of get all the questions out of the way. One of the things that I really believe makes us different or unique in this space is that we really try to focus our time and energy on education. We're in a really unique position to have so many people that are constantly that want to work with us that we don't really have any incentive at all to try to push people to make a decision that's not right for them. So anyway, I just wanted to kind of suggest this is the process that we use as we meet with people. We want it to be really educational, low pressure or no pressure, and our goal is by the time you watch this and have met with us, that you have a feel of the concept and strategy to the point where you can say, hey, this is something that could really make sense for me, or no, it doesn't, and either one of those answers is totally okay with us.
Right. And you don't have to go full bore into it. I mean, the way most people use these is you do a policy, you commit to a certain amount in, 5 to 7 years or something like that. And then you layer another one on top of that. And then you layer another one on top of that the next year. I mean, most people have like 5, 6, 7, 8 policies all layering on top of each other. And
yeah, that's a great point. You can absolutely do that. And we'd rather see people start off conservatively and make sure that they're not overextending. Now, one point that we didn't hit on, and we do hit on this in our individual meetings and in the video that we'll send to individuals next. One of the things that we do here is we make these policies incredibly flexible. We use a concept, I'm not going to get into detail, but we call it a funding range, which is just like it sounds. There's going to be a range of dollars that I can put in a given year. So as an example, in your case where you were putting in $60,000 for that first year, we would have created a funding range that's probably somewhere between, on the low end, 15 and on the high end, 60. The reason I mention this is because some people feel like, hey, I'm committing to a number and I have to do exactly that year in and year out. The reality is that there is a whole bunch of flexibility, and the reason for that has to do with the design, the structure. Because we're funding it so heavily right at the beginning, it gives us a chance to create significant flexibility to the point where I could, if I'm a business owner and had a bad year, I could skip a few years of making the contribution, or I could just reduce it. But long and short of it is, I wanted to just emphasize, because I realized I didn't talk about that earlier in the conversation, super flexible, and normally you're going to have a funding range that's about, for every dollar on the minimum side, about $3 on the maximum side, if that makes sense.
all right. So here's what happened with my friend's case again.
Yeah, that's great.
So yeah, he got some good deals, and he wasn't able to contribute the whole 60 grand next year. because good deals came up. So
Yeah.
we went down to the 15 grand minimum. But say next year he sells some assets and he has a whole bunch of cash, he can stuff that thing with not with 60, but what, 3x that?
You can make up that's a perfect example. If in the second year you just put the 15 in the next year you're going to be able to max up to the 60, but you can also make up what you didn't contribute in the previous year.
Also,
So
catch
an
up with
additional
45 to
yeah,
make
an
the full
additional
at 60.
45 on top of that. Yep.
But can you put another bunch off on top of that in year 3?
Well, so it
How
really
does
has
that
to
work?
do with the design and structure of the policy that we start with, right? So if I use an example of 15,000 being my initial minimum contribution, then I'm going to have a maximum up to 60,000. If I go over that $60,000 number in a given year, then we change the taxation of the strategy. And so we want to avoid that. So again, but about for every dollar that's on my minimum, I'm going to have 3. So if my policy, let's say that I'm $1 million earner and I want to be able to put in 200 grand a year, I might create a funding range that's anywhere between 40 or 50 and all the way up to 200. So yeah, I think you're on the right track there, Lane. There is opportunity to do about 3 times the minimum every year. And like Rod said, if we miss something, we can catch up on it, but we don't have to, right? We can just go back and start, making whatever contribution makes sense. And that's one of the things I think that most people don't realize, right? You think of life insurance or really anything else, we think, okay, if I have a payment, I have to be exactly on that payment. Well, there really is a lot of flexibility inside of this strategy, and there kind of has to be, right? Like we're dealing with business owners often, we're dealing with investors often, and so we need to make sure that it works regardless of an individual situation. Make sure that they have the flexibility to accomplish what they need to.
Right. Okay. I think that's where I was kind of off a little bit. So you want to set that high end at your max.
Yeah, you got it. And then you can pile on top of that, right? So let's say that I start with $10,000 as my maximum, but maybe I get a raise or my investments are going well, and then I could always stack another policy on top of that where I create another 10 grand, or maybe it's 20 grand. Like it's really one of those things that's, again, very flexible, and we can build it and will build it to fit the person that we're talking with.
Right. And then let's talk a little bit about funding terms, because I mean, in this particular one, it was like you're committing to 60 grand every year. I could put in 15 for like you said, you can do like a minimum of 25% or approximately.
Yeah.
But it's usually like a funding window of like you got to commit to like 6 years or something like that, or plus or minus a year. So what's the norm?
Yeah, so our rule of thumb on that is whatever the minimum is, that we need to plan on funding at least 12 times that. If we fund 12 times that, over whatever period of time that is, right, because it is flexible.
Right, so it could happen in 3 years,
Yep.
right? I could fund it for... So what we tell people, like Rod's saying here, is we can fund it all in 3 years and be totally done, 3-4 years, and never put another dollar into it and work great.
Yeah, as you have the flexibility.
Yeah, I
you're
like
taking
that.
advantage of that flexibility. It may take you 5 years to get there, and that's fine, right? But that's kind of the rule of thumb is 12 times.
I've never heard of that before, but that makes perfect sense now that I.
Yeah, well, again, think of it this way. Like sometimes, again, we have to back the curtain up a little bit and just think of it really logically. What I'm doing essentially is I'm paying 4 times my premium in the first year and the second year, right? So I have the ability in any given year to fund it 4 times. Well, if I funded 4 times my premium, well, then that means I could, if I couldn't make a contribution for the next 4 years, my policy would still be intact because the minimum requirement would be 15. Well, what happens is once we get to that 12-year mark, then we're at a point 12 years of the minimum mark. Then I'm at a place where the policy is easily generating enough cash value through the dividend and through the guaranteed interest to more than cover the policy, any cost, and keep it growing at the 5 to 6% return number that we talk about.
Right. So at that point, you don't contribute anything more, and you're kind of in nirvana status then.
Well, that's the cool thing. You absolutely can do that. Or you could continue to contribute to it, right? So the nice thing is I have the benefit of being able to say, hey, I could stop this after I've done it for 3 or 4 years, or I could keep doing it for 20, right? Like there's again, we wanted to focus on flexibility, and that's part of the reason that we use the companies that we do. We want to make sure that we're dealing with companies who are stable, who have been around for a long time, have a good track record, um, that produce a consistent and predictable return, but also that allow us to be flexible with the policy. And there are companies, good companies, who just don't have a lot of flexibility. And so we'll generally navigate to places where we can get both that value from a strong underlying company along with the flexibility to be able to do the things that we're talking about.
Right. Right. Okay. Yeah. So, I mean, obviously this isn't free, and it is, there's a life insurance component to it.
Yes.
And here's the deal, guys. Like, a lot of the fees are front loaded. So you're going to take a hit to you're going to stick in 60, but you're only going to get access to about 45 of it, or
Yep.
maybe even a little less. Like, what are the general rules, the percentages?
Yeah, it's usually 75 to 80% in the policies that we use. If someone was much older, it might skew a little bit below that. If they're young and super healthy, it might be 82%. But basically, we're inside that 75 to 80%. So your example, 60,000 goes in, 45,000 I'd have access to, and maybe I can hit on the cost structure. I always tell people like obviously there's a strong value proposition that exists by using the strategy, and yet you have to go. There's a pain point, right? And that's the first year. Really, that's where the great majority of fees are. And the reason for that is because you're starting up the policy. There's the cost of insurance, and then there's paying guys like us who actually design and structure and do this for a living. So those three things are happening. And again, what we do is we reduce the cost, but there's still some costs that exist. And so that pain point is basically what it costs to get into it. But I want to also emphasize that when we're talking about generating a 5 to 6% return, that's net of cost, right? So anyway, but I think what you're saying is absolutely critical, and we want people to know going in that I'm not going to have access to the full cash value in year one. Once I get a few years down the road, then my cash will have surpassed what I've put in, and I have access to the full amount. But initially, there is going to be that drop off, and then over the long term, we tell people to expect that will be somewhere between 0.5% and 1% as a total fee. I use that number even though it doesn't necessarily fit exactly with life insurance, but most people are familiar with like brokerage accounts. And if I told you, hey, we've got this brokerage account here, we're gonna keep it as low fees as possible. If I said, can I get into that for 50 basis points or 0.5%, most people would feel like that's a really good fee structure, right? So life insurance, upfront, it's a higher cost. Over the long term, we're going to be under 1% and generally even closer to 0.5%. Is that helpful, Lane?
Yeah, so let's kind of put it to real numbers here. So in that scenario, $60,000, you're getting access to that for $45,000. That day one, you can kind of take a loan from yourself and
Right.
get access to 45,000. But that, as time goes away, and from my experience, year three, you're putting in another $60,000, and you're kind of getting more like 90% of that out. And then by the time year six comes around, it's basically nothing. So if you're kind of envisioning this on a chart, you're seeing the fees going from like 25% the first year, then 10% the year three, and then 0. So it phases out in pretty quickly. But
You got it. And what we'll do is we'll make sure that each person we visit with gets a copy that they can look at and say, okay, what is the cost? What is the cash value? How's it going to grow? And so we'll be really transparent about everything that's happening in the policy and get into as much detail on those types of things as any person wants to.
And it's going to be inclusive of all costs, right? There's no like additional that you have to pay us at any point or anything like that, right? It's all inclusive.
What you see is what you
the
get.
net result of all of those things.
Right. I mean, it's something I do for myself personally. So I think that's the only downside, is that you're taking that liquidity hit in year 1, 2, and a little bit of maybe 3. After that, it's pretty much nothing.
Yeah,
So
I think you nailed it. I think that's important, and that is the biggest reason why some people don't. So we know it's over the long term an incredibly successful strategy, but we always understand that, sometimes it's a matter of timing, or whatever. And our goal is just to try to educate, help people understand it, and so pointing that out, I think, is really important.
yeah, and I think this is where, like, a lot of my coaching clients, like, we put together a holistic plan where life insurance is usually anywhere from, like, you know it's a minority of the where we stick all the money, especially if there's every situation is a little different, right? Like, I have some clients that are like, they got a $2 million of liquidity, and it's like, oh my god, like, what do we put their money in? It's like, well,
Sure.
we're not going to put all that money in one place, so life insurance is a good intermediary into that time. But of course, you don't want to put too much, right? It's just
Well, so it's again
every
like,
situation is different, is what I'm
yeah,
saying.
I
So
think I think that's 100% true, right? I can get away with flowing money, a lot of money through my policy if I want to, right? But I think what you're saying is also true. For some people, it's more of just getting a comfort level initially. But what we find is that over time, as people use the strategy, they'll flow the majority of their investment money through it. But there's going to be other monies that exist in people's world. So we're certainly not expecting that you're going to capture every dollar into the policy, but for that money that I'm trying to set aside and build up for investment purposes, that's really where that goes through. And so again, it might be if I'm a $200,000 earner and 20% of my I'm trying to set aside 20% of my income for investment purposes, well, I might end up putting 40 grand a year in or something like that, right? And really that's going to apply across the board. So, like you said, we want to build it and make sure it fits for each person that we talk to.
yeah, a couple of examples I kind of comes to mind in my, like, just countless of calls with folks. One person, they may be having like two, three, $400,000 of liquidity, not too much,
Mm-hmm.
but this whole world of alternative investing has kind of piqued their interest recently, and they're still another year, 18 months away from even investing. Like, they're super noobs about this stuff.
Sure.
So what I would suggest for a lot of those people is, like, look, like, this life insurance, you pay a lot of the fees up front, and it takes a while to kind of charge up in a way. So it might be good to kind of start off with the life insurance thing. And as you're learning, as you're consuming countless audios and podcasts and books, and going through the stage, we're actually going on forums and stuff like that, because eventually everybody grows out of that.
Sure. Yeah.
You're letting the policy charge up. So that's a good scenario I see. The second scenario is like that, that person with just a lot of liquidity, and especially, like, those doctors out there with that high liability. It's another good place of stuffing it. But at the end of the day, guys, it's like, just sign up for an hour of coaching with me. I usually can figure this stuff, point you right in direction, like 30 minutes. And it's not gonna be good as if you sign up for the full coaching package, but it's like, come on, guys, like, don't be cheap on this stuff. And I'm not a fan of, that kind of stuff, like coaching and stuff like that, and paying for it. But I'm like, man, don't be a bonehead, guys. Like, seriously.
Right. It's all about, I mean, really, the difference between people who are wealthy and people who aren't, has to do with decision making. And so I mean, I agree with you. I think
Right.
there's a
I mean,
place for money.
Rod and Christian are the experts. I mean, they'll talk your ear off on this, like, EIUL, IULs, like the difference between them. And I don't really, you guys have like this white sheet. I don't really understand it, to be honest. But what I do know is, like, a little bigger picture, and like,
Yeah.
hey, this kind of deal flow we have coming, and how to kind of fit it in that holistic picture. Like, for me personally, I like to use this in terms of, like, a place, I call it the on deck circle. So me as an investor, I invest in private placements and syndications that usually have minimum investments of $50,000. So I call each $50,000 stack of money as a bullet. So I always like to have at least one or two bullets in the chamber, because if a deal comes up, it just always happens where another good deal comes up a few weeks later, or a couple weeks later. So what I want to be able to do is take a loan from my insurance policy with using this thing and be able to have that next one ready to go. I always have that third bullet stashed around somewhere in secret, but it's, the first bullet and the second bullet aren't in a checking account. I got nothing in a checking account.
Yeah, I think it's good strategy, and like you said, we'll make sure that we're helping people to build out the same kind of strategy that already fits for you. So it's good advice.
Yeah. Anything we missed, I think, guys? I think at the end of the day, this is what the wealthy people do. And like, I believe in the strategy. The only thing you have to weigh is like, the fees up front. And if you got to kind of balance it with your liquidity. Like, I think a situation where this may or may not work is that guy has no money and like,
Sure.
he needs like 10, 20 grand to buy that first rental property. It's like, dude, like this stuff will come later when you get some money. But everybody else, this makes total sense to me.
I like it. Well, I think you summed it up well. I don't think I have anything else to add, other than that. We'll look forward to talking to some of you, and like you say, we'll kind of try to make it fit your situation and focus on understanding the concept better, so you can decide if it's something that makes sense.